The United States has a budget deficit problem. Whether it's resolved by spending cuts or tax increases or some combination of the two, one thing is certain, something needs to be done. So in 2026, the Tax Cuts and Jobs Act is set to expire, and today we're going to talk about that.
Well, it's just one more example of mo money, mo problems, or mo debt, mo problems, as we might look at the federal government. And what we want to do at the outset is give some practical ways that you might be able to take this information and use it to think about the next couple of years. Now, you're going to need to do this in concert with a financial plan overall and kind of look at your specific trajectory. So don't take this as something that you definitely need to do. But because taxes are lower right now than they probably will be in a few years, we look at it and say, okay, what are the levers that we could pull to take advantage of this? And whether it is contributing to a Roth 401k rather than a traditional 401k and going ahead and paying the tax upfront, or whether it is doing a Roth conversion to go ahead and take advantage of lower tax brackets, because that 28% tax bracket that used to be in place prior to 2018 dropped to 24%. And that is actually lower than that 25% tax bracket that's just one lower than that it will be coming in a couple of years. So we've got some elements in there in terms of where the tax brackets sit right now that you should really think about taking advantage of and how it might apply to your financial plan. In short, you do things now so that in a few years you have some flexibility regardless of what happens in the tax world.
Right. And we want to also say we don't know what the federal government's going to do. They could continue on the Tax Cuts and Jobs Act and allow it to continue to grow, or they might enact new legislation where the tax code changes yet again. We don't know. We don't know where this is heading. So we are presuming that the Tax Cuts and Jobs Act will expire because as of the second quarter of 2023, the U.S. debt was roughly $32 trillion. Now, if you think about it, the U.S. has about 330 million people. And if each citizen paid a mere $100,000 to the government, then it'd be done. But I don't know about your kids, Spencer. Mine don't have $100,000 each to give the federal government, much less every adult and every child in the country. So we do know that there is a cliff. There is some problem that needs to be resolved. And so when we look at this, we're saying we're presuming that it's going to be sunsetted. But all that to be said, the government could do something in between now and then. So with all of these things, again, like Spencer was saying, take a grain of salt and take it to your financial advisor. But we want to jump in here and just give some key overviews of the Tax Cuts and Jobs Act. It was signed into law in December of 2017, and it became effective in January 2018. Several key changes were made both to the individual and corporate tax filings. But today we're really going to focus on the individual. So we're not going to jump too deep into anything corporate tax planning wise, just more how does it affect individuals? And then we're really going to focus on what is going to happen if that's going to sunset. We're going to look at standard deductions, tax brackets, exemptions, state and local taxes, and qualified business income. So coming back to the tax brackets that you talked about, Spencer, if we looked back pre-Tax Cuts and Jobs Act, there were several different brackets and started off at the 10%, and then it moved up to 15, 25, 28, 33, 35, and then the top tax bracket for individuals was 39%. So when the Tax Cuts and Jobs Act came into place, the 10% didn't change. It stayed at 10%. The 15% dropped to 12, 25 down to 22, 28 to 24. So again, like you were saying, below what the 25% bracket was pre-Tax Cuts and Jobs Act. 33 came down to 32. There's no change in the 35. Then the 39 dropped to the 37%. A lot of numbers, but all you need to realize is tax brackets were reduced. Now, some other interesting things are, if you looked back at what income brackets people fell into, I think it was roughly 80% of couples are reporting income, or 80% of tax filers are reporting income of less than $100,000. So really a lion's share of our taxable income from individual tax returns come in that 12 to 22% bracket currently. And so that takes up a vast majority of the revenue that the federal government then brings in. Obviously, those higher brackets are going to bring in a higher proportion of revenue. But if you've got 80% of your people filing with less than $100,000 of income, it's really those low brackets that are going to be affected as well.
Well, and we have to recognize too at the outset, there were some folks that actually found that their taxes went up because there were differences in deductions and what could be looked at there. There were also some differences in terms of how a head of household was defined and how those calculations were done and their tax brackets. So this didn't apply evenly to everyone. But if we looked at it, there was one study that was done that basically said, if you took your total tax bill, what you were paying the government, the average household ended up paying about 10% less of that tax. So let's just say somehow you had $10,000 in tax that you were paying on your $100,000 of income one way or another, 10% less, maybe you're paying $9,000. So it was a break, and it was not uniform across the board, but it did help those who were paying at a higher tax bracket and those who were paying, generally speaking, at a lower tax bracket, because that 15% bracket dropped to 12%. So there was, generally speaking, a lower level of taxation imparted across all of the tax brackets, but not in a way that was huge for most folks.
Right. Well, and as you think about it too, every year those brackets, the income that is taxed within the bracket increases for inflation. So if you increase the bracket, but then decrease the tax rate, it's going to do something similar to what you're saying is there is a likelihood that your taxes would go down. Right. Again, not everybody's did, but a lot of people's did. So when the Tax Cuts and Jobs Act is set to expire in 2026, we would see the tax brackets revert back to those Obama era tax rates that we mentioned before. So if you think about this, if we used a scenario of a married couple with taxable income of $250,000 and inflation to those brackets, if the Tax Cuts and Jobs Act did expire in 2026, all things being equal, their taxes would be roughly $54,000. With the Tax Cuts and Jobs Act, if it were to remain, it'd be about $46,000. So we're seeing that it is going to be more punitive going forward. But again, we don't know 100% for certainty, but this is what we're looking at. So the next thing we want to look at, Spencer, is the standard deduction. So when the Tax Cuts and Jobs Act came into play, then the standard deduction was almost doubled. So if you think about this, we've talked about itemized deductions, clumping and bunching, different strategies that clients can take to utilize that standard deduction. If you're not close to that $30,000 of either state and local taxes, property taxes, your charitable gifts, then it makes sense to use the standard deduction. If you're only giving, if your itemized deductions are only $20,000, it's less work for the IRS, it's less work for your CPA, and it's less work for you because you don't have to gather all those receipts and send them off. So the standard deduction was raised, and it's going to be set to drop back down to that lower rate. So oftentimes what we would suggest for clients is, hey, if you're getting close to that standard deduction, maybe don't give as much charitably, or maybe if you can push 2 years of property taxes together and clump and bunch multiple years of itemization together in 1 year and then take the standard deduction in the off year, then it makes sense. This doesn't make as much sense when the standard deduction is much lower and if you're getting over it regularly every year by $5,000 or $10,000.
Right. So not saying that we would give less charitably, but that we would clump those deductions in particular years, so you might not give in 1 year, but double in that second year. Yeah.
So Spencer, while the standard deduction was increased, one of the things that was taken away by the Tax Cuts and Jobs Act were the exemptions. And for some folks, those almost got a little bit of a benefit because if you had a standard deduction, you could also add exemptions, and then you're almost getting closer to where the standard deduction is currently. But you have to have a lot of kids or a lot of dependents. So how do exemptions work, and what's going to happen when the Tax Cuts and Jobs Act expires?
Well, roughly speaking, if we go back again to tax brackets and tax code 10 years ago, every person that's in your household that is a dependent in your household, you get an exemption for, more or less, and that's about $4,000. So if we ran this forward, you'd say, okay, well, if we have a married couple that files joint, they'd have a little over $4,000 apiece for that personal exemption. a little over $8,000 together. If we cut the standard deduction in half, but then we add the exemption back in, then we're getting close to where the standard deduction is these days. There was also a lower level of credit given for the child credit there prior to the Tax Cuts and Jobs Act that was increased for the Tax Cuts and Jobs Act. And so families overall tended to see their tax bills go down via the increase in standard deduction, even though they lost the exemption because they also got that child tax credit increased. So all of those different pieces coming together, again, tax bills generally dropped, but we need to be aware of the pieces. And if we go back to a place where there are exemptions in play, then that's one more thing to track and keep, in there. And then also, to your point, again, we'll incentivize people to be able to contribute charitably and track all of their state and local taxes, which there's been a cap on, here.
Yeah, and that moves right into our next factor, is that the state and local taxes has been capped at $10,000. So if you are in a state with no income tax, property taxes are low relative to other pieces, you may never have utilized up to $10,000. But states out west and the Northeast with high state income taxes and high property taxes, they were penalized even more so because maybe they were able to take deductions of $10,000, $15,000, $20,000 based on income or property taxes, that was then capped. And so as we see this expiration, the sunsetting, now, again, coming back to the different elements, well, if you couldn't itemize before, well, now you've got a $15,000 standard deduction. Well, if you've got $20,000 of state and local taxes, you're already above that. So any sort of charitable giving exemption is just going to continue to push that value up. So that is set to sunset, where state and local taxes can be deducted once again.
Above and beyond that $10,000 number, which is significant. That was kind of a double whammy for a lot of folks, and it was one of the things that caused the greatest outcry, certainly for Democrats, but even for some Republicans that were from blue states, because taxes being higher in some of those venues. So it'll be interesting to see how that negotiation moves, because I could see that cap being removed one way or another, regardless of the direction, just because it's so unpopular in some states. Right. But the counter argument is that we shouldn't have taxes be a driving force on the state level, and local level shouldn't be a driving force of what we do on a federal level in terms of how we calculate those tax obligations. So we don't know where things will go, but if they sunset, then we've got a whole different set of considerations.
Right. All right, so this last one is qualified business income. So you want to walk us through what is QBI and why is it beneficial to self-employed individuals?
Well, big picture, QBI, qualified business income, has been a boon to self-employed individuals, contractors, people who run small businesses, even some folks who run medium-sized businesses who qualify because they hire the kind of folks that are kind of preferred by the government in giving this tax deduction. So basically, it can be up to about 20% of the gross income of the business that would be passed along in a Schedule C type of environment or other type of business that's out there. So it can be a significant deduction for folks. There is a phase out there that's a little bit south of $400,000 when applied to taxable income. And so there are some provisions that keep it from being too significant. But if you think about it, if you had $350,000 of income that QBI then applied to, and you've got 20%, there, then that could be a deduction up to $70,000, just as an example. So that's a pretty significant deduction, because if you're paying, again, tax at something like 24% on that income, then your overall deduction is north of $15,000. Your overall tax credit, I should say, is north of $15,000 there in many circumstances. So it is significant, but I think at the same time, it's a small piece compared to a lot of others. Most Americans, that's not how they receive their income, and so this is just to a subset of folks that it would apply to who are business owners.
And what we'll say with all of this is there are many more changes that are set to sunset with the Tax Cuts and Jobs Act. This is in no way comprehensive, right? But these are some of the ones that we see impacting our clients by and large, or some of the ones that we get more questions about than anything.
Sure. Well, and again, we come back to the actionable pieces and we look at this and say, okay, we have a higher level of standard deduction, so let's consider doing clumping and bunching with our charitable giving and with our tax payments on a state and local basis where possible. We think about Roth conversions, as another thing, as we talked about at the outset, doing that while taxes are lower, and then the final piece being really contributing to a Roth 401k or Roth 403b rather than that traditional side of things for the next couple of years. There are other pieces that are, something to consider, but those are the three biggest ones that we see on a day-to-day basis that we want to encourage people to think about over the next couple of years before the Tax Cuts and Jobs Act might sunset in 2026.
That's right. Spencer, thanks for walking us through some of these Tax Cuts and Jobs Act elements. Clients, if you have any questions about this, feel free to reach out, and we will see you again next time. If you like these financial planning videos, please share it with a friend, and if you have questions, go to our website at seriousretirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at seriousretirement.com. The information in this recording is intended for general educational and informational purposes only, and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.